Hi class, in this video we're going to go over chapter 29 on international capital flow and also exchange rate. All right, so we're going to talk about how the foreign exchange market works and also supply demand shift in the market, the market economic impact of exchange rate, and lastly, the exchange rate policies. So first, let's talk about this trade deficit. Now, whenever we're living only in America, we don't go anywhere else, we rarely ever think about exchange rate. But whenever you have import-export, the exchange rate become very, very important, right? So imagine that we do a lot of trade with European Union. So let's say we're buying wines and cheese from France. So when we go to France to buy those goods, we're not paying them with US dollar. We're paying them with local currency, which is the euro, right? So we have to exchange our US dollar to euro. Now, let's suppose we have a huge trade deficit to European Union. That means every year we're sending out more dollar to Europe to purchase all those wine and cheese. Then what kind of impact would that have for US economy? They're good or bad for U.S. economy. Now, if you ask many politicians, they will say, "Hey, that's horrible," right? Because politicians always say, "Hey, that's bad for the jobs in America. Trade deficit's bad. That's the worst thing that ever happened." We're going to talk more about this in the later chapters. But for now, we're going to focus on the impact of trade deficit on the value of U.S. dollar. So if we keep doing this, right? So if we keep buying more and more stuff from, let's say, Europe, that means we need to exchange more dollar to the euro. So there will be a higher supply for dollar, higher demand for euro, and this will actually push up the value for euro and push down the value for dollar. So if we have a huge trade deficit, then this might result in a depreciation of US dollar, or dollar become weaker. And then if you're thinking, hey, that sounds even worse, right? So not only are we losing jobs to Europe, we're also losing the value of US dollar. But it really depends on who you ask, right? Because a weak dollar might be good for US economy. Because a weak dollar will put many of our export business at an advantage over other competitors overseas. Because your US production at home is paid with US dollar, right? So our workers in America are being paid with US dollars. So if the dollar is weaker, that means everything produced in America is cheaper now. So with a trade deficit, this might actually cause an increase in the US export later on, because everything in America being paid with dollar is becoming cheaper as well, right? So there's not really a set answer for U.S. economy, whether trade deficit is good or bad for U.S. economy, because there's so many variables involved. Okay. All right. Now let's go over some more details in this chapter. So know some definitions. So what are dollarized? So dollarized is whenever a country other than U.S. that's using U.S. dollar as its currency. Um, sounds a little strange, right? So why would other countries want to use our US dollar instead of their own currency? That is actually happening, or it's about to happen. So it's been proposed by a country called Ecuador. So Ecuador in the past, 2022, 2021, has been having very bad inflation problem. So the country proposed that instead of using their own currency, they want to abandon that and then fully adopt the use of US dollar as the currency in the country. And they will help to fight inflation in the country. So for many small developing countries, when they dollarize the currency, so abandoning their own currency and use US dollars, this will definitely help with the inflation in the country. But they are also tied them very closely to the monetary policy from US government, right? So imagine that if US has a 5% inflation, then more than likely you're going to see a 5% inflation in Ecuador. But what if US next year is very, very bad? We have a 25% inflation. Well, that means Ecuador will also have a 25% inflation, right? So once the country dollarizes their currency, they really give up control of the monetary policy, give up control of the currency in the country, and then fully adopt the policy and then the consequences of the US dollar. All right. I also know what's a foreign exchange market. So this is when you have buyer and sellers of currencies go to a centralized location to exchange for local or foreign currency. And this is actually a very, very big market, and it's the biggest market in the global economy. So think about, what happened in 2019. So in 2019, one day we had about $5.3 trillion of money being exchanged in the foreign exchange market globally. But for the entire year, our US GDP, now we're the biggest economy in the world, but for the entire year, our GDP was only $21.4 million. So it pretty much means like 4 days of trade on the foreign exchange market is equivalent as one full year of US entire economy. So this is the biggest market in the global market. All right, so there are four type of people who are participating in this foreign exchange market. So first, they're the company who are doing international trade, so import-export. They do need to change for foreign currency to purchase stuff that's produced in other countries. So companies are doing import-export are the first and probably the most active true user of a foreign currency in the economy. Second, we have tourists with other countries. So imagine if you go from here to Europe, let's say you go to Italy, which is very nice, but you need local currency. You need euro. So what you're gonna do, you're gonna exchange your US dollar for euro, right? So the tourists are the second group of people who need a foreign currency. And then think about also international investor who are buying up foreign firms. So imagine, let's suppose we have a investor in America want to purchase a share of BMW stocks. So that will be you need to again the euro first, right? So that's another demand for the foreign currency. And lastly, there will be the investors who are purchasing financial investment but not really involving ownership. So this would be actions such as bond investment or lending to foreign companies, right? So those are the financial investment, but doesn't involve any ownerships. So for all these dealings of import-export, for many companies who are doing import-export, they have a big issue, a big disconnect. So let's take BMW for example. Now, for many cars by BMW, they're actually produced in Germany, but they're sold in America. So this big disconnect is putting company at a huge disadvantage because every week, every month, every year, they have to take the revenue, which is denominated in US dollar, convert it back to euro to pay for the cost. So the cost for workers, suppliers, investors. Now, sometimes when the exchange rate change, that can really impact the company's bottom line. So imagine the company is getting all the revenue with US dollar, and let's suppose next month dollar depreciate, become worth less, then all of a sudden BMW might have a hard time using their revenue to pay for the expenses that still cost in euro, right? So for many international business, international companies, this foreign exchange risk is a huge issue for them. So companies do have different strategies. One strategy company use it's actually called hedging. So hedging is like a buying an insurance policy. So for this insurance policy, you actually locked in your exchange rate for a certain time period. So if the exchange rate changes, doesn't matter whatever direction is, your exchange rate is fixed. That's called hedging. Many financial banks offer this services for companies, of course, at a fee, at a very high cost, but this does eliminate or reduce the foreign exchange rate risk company has. And also for the financial investment, some of the biggest investment, think about the foreign direct investment. So that's whenever you have investors buying directly of another company in the country or decide to join partner with an existing company in the country. So let's say if you think about the Chinese economy, for a long time, the biggest automaker in China was actually Volkswagen. But what Volkswagen did, they didn't go in the country by themselves. They actually find other Chinese company to partner up to build new factories, produce new cars. So that's called a foreign direct investment. So when you're directly investing into the economy. And the other type of investment is called a portfolio investment. So for portfolio investment, you just buying stocks, buying bond. So you still invest your money in the country, but you don't take direct ownership for the country, right? So you're not really managing the daily operation, but you just become a shareholder. Most of the the foreign changes happened, is happening at the portfolio investment level. So many foreign investors are doing this very heavily and also very frequently. The buying and selling of international stocks are very, very common. And it's also happening in America, right? So many of our company in America actually currently owned by foreign investors, and that's called a portfolio investment. All right, guys, so let's look at an example where the change in the exchange rate can really, make a profit for the investors or even break company's bottom line, right? So let's suppose we had this example between British pound and also the US dollar. And let's suppose we expect that right now the exchange rate is $1.5 for one British pound, but we expect that maybe next week that this new exchange rate will be $1.6 for one British pound. So we expect that the dollar will be getting cheaper and then the British pound will be more valuable because it can exchange for more dollar now. So to take advantage of this, the investor can take $24,000 exchange to British pound today, and they'll get them 16,000 British pound. And we're going to hold on to it and wait until the exchange rate changed from $1.5 to 1 pound to $1.6 to 1 pound. And once that happened, we're going to take our 16,000, convert it back to US dollars. So you can use 16,000 times 1.6, and they'll give you 25,600. So compared to what we initially had, which was 24,000, we just made a $1,600 profit. Easy profit, right? But that is if it's move in your direction. But what if it move against your direction? So what if, let's say for next week, the exchange rate become $1.4 for one British pound? So, and in this case, that you might actually lose money, but to make a profit, then you want to do the reverse. So in the previous example, we use dollar exchange for pound to take advantage of this. Now we're going to reverse it. We're going to use the pound exchange for dollar to take advantage of this, right? So we're going to do 20,000 pound exchange for $30,000, and then once the exchange rate changed from 1.5 to 1.4, we're going to take our $30,000 divided by 1.4, and that gives you a new value of 21,429 pound. So you made a profit of 1,429 pound, right? So you can make a profit from either way, but you have to really get your directions right, because if you get it wrong, then you can really lose a lot of money. And if you guys interested, there's a market called a Forex market where many investors go there to invest into foreign currencies. Now, for that Forex market, back in the 1990s, there was a little Asian currency crisis. So at the time, the value for the Japanese yen was fluctuating a lot. And this one day in the summer of 1998, after the market was closed, the value for Japanese yen changed by a lot. And then the next morning, there were investors jumping off building next morning because people lost too much money, right? So this is actually very, very speculative, okay? All right, so know what's a foreign exchange dealer? So this is the banks and firms who are in the business of buying and selling foreign currencies. So roughly there are about maybe 2,000 firms globally that does the foreign exchange dealer, who are the foreign exchange dealers. Many of the big investment banks in America, they're also foreign exchange dealers, and also the one I mentioned before, the Forex market, that's also a foreign exchange dealer. Okay, it's called a number 4, letter X, the Forex market. All right, so whenever the currency is getting more valuable, that's called appreciating. Whenever the currency is losing value, that's called depreciating. Now, whenever you're thinking this about appreciating versus depreciating, there's a zero-sum game here. That means if one currency is appreciating, then the currency to measure against it is depreciating. Because how do you know that you are appreciating? Because you can change for other currencies more. That's appreciating, right? So imagine if we compare again, let's say we compare our US dollar versus Canadian dollar. So this chart here is a little off. So the first chart is the US dollar to the Canadian dollar to US dollar starting 1984, and this one here is reverse, is US dollar for Canadian dollar start 1974. So if you draw a line here, and now both graphs at the same point. So notice that whenever you have an increasing, so whenever the Canadian dollar is appreciating, we see a depreciating for US dollar, right? And then on the other ones, if you keep going, then the Canadian dollar goes down in value, and then US dollar goes up in value, right? So they really goes against each other, right? So if one currency is going up, that means the other currency must be going down. All right, so think about a strong dollar versus weak dollar. We mentioned this earlier. So a strong dollar doesn't necessarily mean it's a good thing. It really depends on who you are, right? So if you are a company in America who does exporting business, you hate strong dollar because every cost you have is all measured in dollar. So if dollar is very strong, that means your cost is very high. But imagine if you're a US tourist who is going overseas. Let's suppose you want to travel to Europe, and then right now dollar is very, very strong. That is great. That means now your US dollar can exchange for more currency overseas, and you can get more money overseas, right? So, for example, couple months ago, actually, no, end of last year, end of 2022, the euro was a little weak. The British pound was very, very weak. So for many US tourists who went to UK, went to Europe, they actually were able to spend more money overseas because their dollar was very strong and they can exchange for more currency overseas. Okay, so it doesn't mean the strong dollar is not always a good thing. A weak dollar is not always a bad thing. Really depends on who you talk to. So for investors who are speculating on the value for the currencies, one reason the demand for currency might go up is whenever people expect the value for currency might go up, and another reason the supply for currency might go up is when they believe the currency value might go down, right? Because really want to hold on to currency that might give you more return later on, right? So if you expect that this dollar is getting hotter, 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 hey, I want to hold on to it, right? Maybe sell for an even higher price later on. But if you expect that the dollar is getting weaker, then you want to sell the dollar, and that will increase the supply for dollar. So, so next, imagine the exchange rate between US dollar and then the Mexico peso. Now, we're going to look at this separately into two different markets. We'll look at this as the market for US dollar, so the panel on the left, panel A, and also the market for the Mexico peso. Now remember, they are trading against each other, so the other end of the equation here is the other currency, right? So, for example, if you look at the vertical axis for panel A, vertical axis is your peso per dollar, and then for panel B, the vertical axis is the dollar per peso. They're inverse of each other. So both at point E, we have our equilibrium. Now, let's imagine something happens. Let's imagine the government says, we expect that the peso will likely to get stronger. Now, if that news information came out, then that means there will be a higher demand for peso and then a higher supply for dollar, right? So high demand for high supply, that will really lead into a change for peso. So for this exchange rate, it's very similar to the behavior of individual prices. That many often the expectation for investors will actually cause the market to move in line with the expectation. So if our investor believe or expect that peso will be stronger, that will cause our investor to buy more peso. So demand goes higher. So that will definitely increase the value for peso. At the same time, we're going to supply more dollar for peso, right? So again, that will cause the peso value to go up. So because we change our behavior due to our expectation, then this behavior change actually did cause the price to increase for peso in line with our expectation, right? So investor expectation is really important for the future exchange rate. All right, so next thing about let's talk about how does interest rate impact exchange rate. So think about money is flowing freely between countries. Let's say that in Mexico, you might open a saving account and they will pay you 5% per year. But what if you go to America, you open a saving account, they pay you 10% per year. And what would that do? That means more people would take the money from Mexico and put into the US market. But doing that, you gotta exchange for dollar first. So that will increase the demand for dollar. So demand goes up. They'll also increase the supply for peso. So both of this change put together, you're gonna see a higher exchange rate for dollar to peso, right? So this actually might be a very favorable move for investors because on one end, you're getting higher interest rate in America. On the other end, because everybody doing this, this also caused appreciation of US dollar. So this can really cause multiple impact in the economy, and that's called a multiplier effect. Okay, but we're going to talk more about it in the later chapters. All right, so for inflation, whenever you have inflation in the economy, that's always bad. And whenever you have high inflation, this will also cause a change in the exchange rate. So again, we're going to see another multiplier effect here. Imagine we have high inflation in America. So US dollar is losing buying power because everything getting more and more expensive. And what do people do? They're going to dump dollar and then purchase more of other currencies. And that process actually caused the value to go down for dollars, so depreciation. So on one end, we have inflation, which means price goes up, so dollar is buying less and less and less. And because investor also change behavior, dumping dollar, and that should cause the value for dollar to go down even more. So this can cause an even deeper decrease in the value for dollar. So it's a multiple impact for the value for dollar. All right. Also known as arbitrage. So arbitrage is whenever the investors are buying and selling a good cross borders take advantage of the international price differences. So let's say that for I don't know maybe let's say order chicken fried rice. So let's say you can buy the order of chicken fried rice in America for $5. You can sell the order of chicken fried rice in Mexico for $7. What do? You buy the chicken fried rice in America and then right away sell to Mexico. And that profit you make, that's called arbitrage, right? So in the foreign exchange market, investors are looking for arbitrage all the time, right? Because remember, we have this separate market here. You have so between peso and dollar, you have a market for peso, you have a market for dollar, right? So sometimes those two exchange rate, they might be misaligned just a little bit, and that misalignment, that's called an arbitrage. So investor will go in, take advantage of misalignment, and then try to make a profit out of it. But that process will actually cause the market to align itself, right? So let's say right now in the Mexico market, peso is a little cheaper, and then in the US market, peso is more expensive. And what do? You go to the Mexico market, you buy the peso, right? You get the peso, and then you take it to the US market, sell the peso. But doing that, when you buy the peso in Mexico, that cheap peso is not cheap anymore because you buy more of it, so price goes up. Now, in the US market, you're going to dump your peso, right? But that process actually causes an increase in supply for peso. So increase in supply will cause the price to go down. So this cheap peso in Mexico, expensive peso in America, but because you're doing arbitrage, that these two prices will get aligned itself more equal, right? So for anybody who's interested in study finance, you're going to learn a lot of opportunities. Also, companies, investment bankers who are doing this arbitrage. But that's the old way. Now all the arbitrage is taken advantage by the computer programmers, right? So computers doing everything now. So because the investor is too slow. All right. Also known as the purchasing power parity. So sometimes that if you see something that's at different prices, you can align the value for the currency to the different price level. So one of the best example we use in economics is something called Big Mac index. So think about the Big Mac cheeseburger from McDonald's. Doesn't matter who you buy from, you're buying the same. It doesn't matter which country you buy from, you're buying the same Big Mac, same ingredient, same size, same everything. But if you adjust each Big Mac in different country according to the country's exchange rate, you're gonna see some country have a more expensive Big Mac, other countries that has a lower price on Big Mac. So that you can tell how much is the real cost of living in the country, and that's also known as the purchasing power parity. Now, central banks are also very concerned about the exchange rate because whenever you have exchange rate, this will definitely impact our net export. So that will definitely impact your aggregate demand in the economy. Remember, we have the four components for aggregate demand: consumption, investment, government spending, and net export. So exchange rate will for sure change our net export in the aggregate demand market. So for most financial market in the world, whenever you borrow or lending money, you always borrow and lending money in terms of either US dollar, the euro, or Japanese yen. Now that borrowing and lending between different countries normally is fine, but if you have any changes in the exchange rate, that would definitely cause a impact on the ability for the country to pay the money back. One of the worst example or the most well-known example again is the Asian currency crisis. So that happened in Thailand in the mid of 1990s. So Thailand saw a big devaluation of the currency, which is the Thai baht. And what happened was that a lot of the banks were taking advantage of the difference in the interest rate between the US market and then the Thai market. And also at the same time, the Thai government promised that we're going to keep the exchange rate fixed, right? So imagine that we have a scenario that a bank can borrow $1 million in America and then pay a 5% interest rate. Now we're going to take the $1 million, bring to Thailand. Now, because we have a fixed exchange rate, we can change the million US dollar into 40 million Thai baht. Now, for the 40 million Thai baht, we're going to lend it out to earn a 6% profit. So we pay a 5% profit, we earn a 6% profit. So by end of the year, then we have a positive 1% profit. Now, for this 1% profit, so that will be so 400,000 Thai baht, right? So, but we gotta convert the money back to US dollar to pay off the money we borrow. Now, if the federal government in Thailand kept the same exchange rate, so still at 40 baht per dollar, then this 42.4 million Thai baht can exchange for $1.06 million. Now we need to pay back the $1 million plus 5% interest, that's a total of $1.5 million. So our profit is already 10,000 US dollar or 400,000 Thai baht. But what if the exchange rate changed? That what if next year we don't have a fixed exchange rate anymore? The number changed from 40 to 50 baht per dollar, right? So that will be a devaluation of Thai baht. So now your $42.4 million, 42.4 million baht can only exchange for $848,000, but we owe $1.05 million. So when you pay the money back, we actually lose about $202,000, right? So when the exchange rate changed from 40 to 50, that would definitely cause a change in the bottom line for companies and also banks. And that's part of it is what happened to Thailand in the 1990s. So many banks will borrow money in America that with a lower interest rate and then charge a higher interest rate in Thailand. But when the exchange rate changed, that those banks just having hard time paying the money back. So there were many bank failures in Thailand, and that caused a huge detrimental impact on the Thai economy. And then because of that bad impact on the economy, that actually caused the Thai baht to devalue even more. So made the problem even worse. All right, so there are different type of control of currency values. So they're called floating rate, soft peg, hard peg, or merged currency. So floating rate is whenever the foreign exchange, the value for the currency is flowing freely. The government has no control over it. Many currencies in the world are freely floating. So think about the US dollar, the European euro, the British pound. They're all floating freely currencies. Now, peg means you're going to attach the value of your currency to another currency, right? So for this peg, this is also known as a fixed exchange rate. So you might have a soft fix, you might have a hard fix, right? So soft fix that we're going to put up limit on how much the exchange rate is, right? So whenever the value reach a limit, then the government step in and then try to push or increase the value back to within the limit. That's called a soft peg. A hard peg is when you really try to fix the exchange rate at a certain value. So let's suppose that, let's say Chinese government says for the Chinese yuan, we're going to make sure it's fixed at 8 yuan for $1 at a fixed value, right? That's called a hard peg. So if you look at the exchange rate for US dollar and Chinese yuan, for a long time in the 1990s, if you look at the exchange rate, it's flat, right? So that's a hard peg. But since 1990s, especially in the later years, recently, that we do see some fluctuations in the value for Chinese yuan. That's a soft peg now. Okay. And lastly, emerging currencies is just whenever the government decide to abandon their own currency and adopt dollar as the currency. So Ecuador is thinking about that right now. Okay. All right. So floating exchange rate, we mentioned this. So whenever the value is floating freely with no control. So if you look at the value for Japanese yen, for the last 20 years has been floating freely, right? So let's say in the early 2000s, it was 130 yen for $1. And then, at the lowest point by 2011, become less than 80 yen for $1, and then went back very quickly. So today it's a little bit over 100 yen for $1. Okay, so this number here is floating freely. And then again, if you guys just Google FRED, F-R-E-D, Chinese yuan versus dollar, you're gonna see something very differently. Okay. All right, so we talked about this already. So soft pack, you have a limit on how much the exchange rate is. Hard pack, that you already fixed the value there. So for this soft pack, so this will be example of soft pack. So government setting up limit. So whenever the exchange rate reach to a certain point, the government step in using their foreign reserve, try to influence how much the exchange rate is. And lastly, we have merged currency. So this is whenever the government give up their own currency and adopt a foreign currency. So also know what's the Tobin tax. So Tobin tax is whenever the government try to put restrictions on the flow of international capitals. So imagine we don't want people to bring our money out of the country now, or bring money into the country. So by putting a tax on the exchange rate, that might cause a decrease in the transactions of currency between different countries. So there are many countries doing this, but the way most country does it is not necessarily as a tax, but more such as a quota. So let's say, hey, for the entire year, for every person in the country, you can only exchange for, let's say, $1,000, right? So that will be a quota for it. But you do see many taxes in this scenario. So imagine if you want to wire money to another country, then there might be a very high tax for it. That's called a Tobin tax. Okay. All right, guys. So that's it for this chapter. Any question, let me know, and I will see you guys for next chapter. All right. Bye bye.